Hello, everyone. Thank you for joining us today for Pieces of the Puzzle. My name is Michael Finch. I'm with SVN SFR Hub Advisors, and I will be moderating this discussion with our esteemed guests today. So I want to take a moment here to start with a round of introductions, and I'll go last. But I will start here with Peggy Dalton with Stewart Title.
Hello, everybody. Peggy Dalton, Stewart Title. I'm the Director of Operations for Stewart's National Solution for Investors and for Default Services. And I'm happy to be here today.
Thank you, Peggy. Josh?
Yeah, Josh Jensen. I'm the co-founder and CEO at Inspectify. We're a vertically integrated property inspection platform, and excited to be here as well.
Thank you. Mike?
Mike Tamalevich with Marketplace Homes. I'm the COO. We currently manage about 6,000 doors of SFR properties across our portfolio, other large institutions, and about a third of that is retail investors. We have a full stack of advisory services to operational partnerships with an integrated brokerage that allows us to act as a acquisitions channel for the clients that we work with.
Wonderful. And Jacqueline?
Hey everyone, I'm Jacqueline Gonzalez, and I'm a sales manager here at Civic Financial Services. I've been with the company for over 7 years and have seen us grow from 10 employees to now over 400. At Civic, we focus on the financing for residential investment properties, with our borrowers focusing on buy and holds and fix and flips. Michael, thank you for having me today, and thank you all for joining.
Yeah, I appreciate everybody joining. And again, my name is Michael Finch. I'm a principal founder of SVN SFR Hub Advisors, SFRhub.com, and SVN SFR Capital Management. We do a lot of things under roof, from brokering large scale portfolios and build for rent communities, through our SFR Hub Advisors brokerage. We do a lot of data research and valuation through our tech platform and consulting at SFRhub.com. A lot of the consulting focuses more in the build for rent space, and SVN SFR Capital Management is a acquisition and aggregator of build for rent communities around the country. So very excited to be speaking with you all today and moderating what will no doubt be a great discussion on today's biggest barriers of entry in the SFR and build for rent market. So with that said, we want to just jump right into what are we seeing today? What are the barriers that we're facing in terms of acquiring portfolios in today's market? And I think it's probably best to let the debt speak to this, because I know that's seemingly everybody's biggest challenge today. Jackie, what are you seeing out there, and how is it affecting the borrowers that you're working with, sellers, debt, equity, and everybody on this panel and the audience that's watching?
Yeah, I think it's no secret that right now a lot of investors are seeing rates increase, right? And it doesn't matter how far along their loan is in the process. Sometimes these loans are getting retreated, and we're seeing a lot of fallout from these investors or from these lenders. And with their rates changing, they either no longer qualify for the loan that they were originally seeking, so they're having to look for other lenders to help them finance the transaction that they're working on.
Sure. And Mike, through all the services that you guys provide, how are you navigating through some of these challenges?
Yeah, I think the biggest thing right now is specific to build for rent. There was always, like, historically maybe 100 to 120 basis points worth of delta between the cap rate of buying something at C of O opposed to going through that development phase. And it's really similar to what we're seeing on the scattered side, where a lot of the institutions that we work with have definitely minimized or halted altogether buying one-off properties on the MLS to portfolio together right down the road, just because they don't have maybe necessarily the clarity of what the debt package is going to look like, right? So swinging that back to the build for rent side, Michael, I remember, 7-8 years ago sitting at conferences, and there was like you and me and like 6 other people in the build for rent room that were talking about this, because it was kind of like nobody really thought about it. And now you have, build for rent, which most people think about as like the enclosed community, right? And then you have build for rent scattered site, and build for rent scattered site might be, one property in one neighborhood. It might be 15 properties in a neighborhood of 100. And we've been doing this for a long time, more so on the scattered and individual side. And it's really bringing some new value to the table, because obviously builders are coming to us now looking to move excess product within a existing community. So you need to be able to partner with people that have the ability to understand what build for rent is, from a basis, but then also manage it more from like a scattered site perspective, because you might not have necessarily the concentration of 100 or 200 units within the same neighborhood.
Sure, and I think that brings up a good point. And Joshua, maybe you'd like to add to this. When you're acquiring portfolios, whether they're scattered or build for rent, aside from navigating through some of the debt challenges, how are you assisting your clients, between the scattered SFR and build for rent communities, and what are some challenges that you've been seeing recently with the rising rate environment, kind of in the midst of working with your clients to get through some of these inspections?
Yeah, I mean, I think the biggest challenge operationally is really any component of that acquisition that requires human capital becomes much harder when you do it in bulk, right? Like, your classic SFR fund, may have some folks in the field to acquire the properties, and when you're doing one-offs, every month, maybe off MLS, like you've got the capacity to handle that. But if you're acquiring, 10, 20, 30, 100 homes at once, you're not staffed to handle that, right? And so if it's doing the initial underwriting, if it's inspecting, if it's scoping, if it's doing the repairs, if it's, a non-new construction, it's a pretty significant stress test to be able to handle that level of volume that comes with it. And if you add scattered site on top of that, it becomes even exponentially harder, right? Because then you've got bulks, but they're not all in one location. So even if you had enough teams you could fly to do it, it becomes even harder, right? And so I think what a lot of folks end up doing is, they will underwrite effectively only a small portion of that overall portfolio. And as we all know, I mean, maybe a little bit within build to rent, but especially in the SFR side, like homes are heterogeneous, right? Like there is differences between them. And so, if you're only really truly understanding a portion of it, you're inherently taking risk. And so I think that's really isn't a new problem with what's going on in the debt world, but it's a continued problem, right? When you're, trying to run a fund profitably, you can't really, afford to have a huge amount of headcount to be able to support these lumpy acquisitions that happen from a portfolio perspective.
Michael, I'll just add to what Josh said is, you always think about it on the acquisition side, right? You're thinking about taking down, whether it's 20, 50, 100, 200, 500 assets, right, at one time. And specifically, if you're buying new stuff, majority of the time when you're buying that, you are getting some sort of warranty, right, from the builder. That's going to cover you for a year. And it's like, what do you do 10, 11 months into it to make sure you can get into all of those assets, to make sure that you can give a punch list back to the builder to be like, these things need to be fixed in, these units and all that sort of stuff. And, we partnered with we've certainly partnered with Josh and his team to get scale around that sort of thing, to where, you know, we aren't necessarily going to have enough people to spread out, especially if you're breaking it up a little bit by geography. So that's, you know, that's something that, you know, it comes on the tail end of it, but you need to be prepared for it when you're entering a space like this.
Yeah, and I think that's an important point, especially for, you know, new entrants to the market that, you know, that may not have the vertical infrastructure of some of the very large operators. It's essential to create that team, you know, which is essentially, you know, everybody here on the screen. You know, you need to have the right property manager, you know, the right debt in place, you know, the right group to help you inspect all these homes, and you know, leading us into Peggy here with Stewart Title. You know, it's a key piece of acquiring SFR and BFR portfolios, and I'm sure you have some insight onto some of the barriers today of acquiring SFR and BFR portfolios, and would love to hear your thoughts.
So just a couple comments on Mike and Josh's comments regarding the scattered sites for build for rent. We June and July were extremely challenging. We saw 40% of the contracts cancel. And I think that a lot of it did have to do with human capital. A lot of it had to do with, you know, the smaller operators changing their buy box to something that they were more comfortable with, that was less risk for them in their historical experience. And as far as the build communities, what we saw is kind of a stay and hold, some renegotiations, reclass, but they also added, because other options were made available to them, you know, as Mike mentioned, at a discount or at least a more attractive pricing for them. So the forecasting for the build for rent went up a little bit, and the scattered site is now starting to recover a little bit, probably the end of the year. But for the portfolios that were already in process, and I think that's what Michael wants me to touch on, you know, one of our biggest challenges is, you know, you have an operator with 200 units or in that range, and they put the portfolio on the market. Come to find out, these are existing homes in the SFR market. They've got code liens that are cross attaching to a large portion of their inventory. So they may have 200, but at the end of the day, 60 of them are impacted that can't move. So that's one of our bigger challenges right now. Very attractive portfolios, and then, you know, once title's done, post contract, which is, you know, probably not the most favorable approach, you find out that you're sitting for 6 months trying to clear something, and they've priced themselves out of the market because of rates or changes financially.
Yeah, that is 100%, and I still have a wound healing from everything that Peggy is talking about right now on the brokerage side. You know, I think it is important when you're moving into, you know, a scattered home site specifically with vintage product, you know, to leverage somebody like Peggy to get a little prelim title done, maybe even beforehand. You know, it's an upfront cost, but would have saved a tremendous amount of time for that particular deal that she was referencing, which we opened escrow, I think in February on 100 and, you know, plus minus 25 homes, where the seller had never done any title work and did not know the extent of issues that were underlying the title, and the buyer, you know, which would have been a very smooth 60-day DD, they would have had an interest rate and loan in place that was much more favorable by, you know, April of this year, and unfortunately, you know, due to the extent of title work, they weren't able to lock in a loan rate that was feasible to acquire the deal, and ended up having to drop it. Jackie, would love to hear kind of just, and I'm sure everybody here would, you know, what you're seeing today, you know, maybe where, you know, you're seeing, you know, opportunities in the debt market, you know, good, bad, or indifferent, but, you know, what are you seeing, what's happening, and what should everybody on the panel today listening from, a potential acquisition expect, and what are their options when they're looking at SFR and BFR acquisition opportunities?
Yeah, I mean, I'd say right now, people really want to create a really good team. And they might have been working with a specific lender for years, right? But with all of the rate changes, I think right now it's very important to ask other experts in the market to see what they're offering, asking the right questions about how long they can lock a rate in, for example. Is there a cost to locking a rate? And just asking the right questions to see if there is opportunity to work with other experts in the space.
Sure. So I think it's a good lead into kind of the next question on ways to overcome the barriers that we're seeing in the market, and whenever we're facing these sort of I don't want to use the word recession, but people are using it a lot. But whenever we're facing in challenging environments, specifically in real estate, there are always barriers to overcome, but there are always opportunities to take advantage of. So, I guess, Mike, I'll start with you with that one. What are you seeing on obviously overcoming some of the barriers, but if barriers can't be overcome, what opportunities are out there?
Sure. Yeah, you're 100% right. Right. Anytime there's unrest with anything, there's going to be opportunities out there to take advantage of. So, I think what's really, really important, we see the biggest value right now in, from an inventory standpoint to be able to acquire is existing or soon to be existing inventory from builders, and being able to piece together, 20 in this subdivision, 20 in this subdivision, and that might spread 4 or 5 states, and putting together a really well geo-diversified portfolio for somebody. But the challenge is, goes back to, that owner and making sure that they're building out an appropriate team for that. If they don't have the capacity to be able to manage that internally, you can't go to a historic multifamily manager and expect them to be able to manage a 15 unit development, right? It's not going to be cost effective at the end of the day. So you need to have, whether it's your property manager in place, your obviously folks you're using, for the acquisition side, your debt, your title, all that stuff needs to be incorporated. And looking at it more from a scattered site perspective, knowing that you're working with people that yes, they could effectively manage a 100-unit development for me, but if I'm giving them all these smaller pieces to make up the whole, you just need to make sure you have that team set up appropriately. Otherwise, it's just going to fail because it's 2 different businesses, right? I mean, we see it all the time when you might have like a Greystar or somebody great like that on the multifamily side that can manage a 500-unit development, no problem. But you give them 15 homes in Birmingham, Alabama, the pro forma is not going to look terrific if you model it out the exact same way. So it's all about building the right team to take advantage of the opportunities that are coming in on a daily basis.
Yeah, find the specialists.
Exactly.
Yeah, and I probably should have mentioned this sooner, but everybody here, please feel free to jump in, at any point if you have any additional comments to make to add to someone. Peggy, thoughts on overcoming some of the barriers that we've discussed so far?
Well, I mean, a couple of thoughts. The first one, if you are an operator and you purchased inventory over the last 5 years as is, have someone take a look at it. If your intent is to market it, then by all means have someone take a look at anything that you've purchased as is, if you didn't get the opportunity to to clean up anything that was existing. Throughout the years, we've had operators buy a great portfolio and then come to us afterwards to do the clearance, which is perfectly, it's acceptable, and that's a great approach as well. But if you have purchased something, absolutely come to us and have us take a look at it and see what you have. On the flip side, if you have something that you are ready to market right now, we can give you a quote for the prelim so that you can get a view. Marketing it as a clean title opportunity and a quick close, I think, would be extremely valuable at this point in the market.
Yeah, I 100% agree with that. Josh, what are your thoughts?
Yeah, I mean, I think the reality is like there's obviously barriers for folks trying to do acquisitions, but there's also leverage here now as well, right? Because we're seeing more inventory come on. So in new construction, from builders have had historically really high profitability, and now they're having more existing assets that could be pieced together, as well as just more general inventory in the SFR space. So I think now is the time to think through how you can extract more leverage and value from the process, where maybe there's not really too much you can do on the debt side, right? There's some optimization here and there, but reality is, now is the time to get better terms, both in terms of the purchase price, but also, what we're seeing more and more now is concessions around inspections, right? Like, make sure you do the inspection, and if there's major defects found, now's the time to push for more concessions to get you closer, from a cap rate or yield, whatever your optimization is, right? And so, I think it's probably stating the obvious, but like the dynamics have changed to be more favorable in some capacity to the buyer in terms of leverage. Let's make sure that we're using
100%.
that as much as possible, and I think it goes across both build to rent, in terms of where can we get more value from the builders, but also existing assets in the single family space as well.
Yeah, that's a great point. Jackie, in current conversations that you're having with borrowers, how many are starting to look at taking on, some risk with adjustable rates, with some, and obviously nobody has a crystal ball, but I think there's a general consensus that the Fed will start lowering rates, hopefully Q1 next year. I know there's a lot of talk around that. Are you speaking with a lot of borrowers that are, considering an adjustable rate, to kind of hope to, find something, to get it locked in today and maybe, think of a refi in 2 or 3 years?
Yeah, so one of the things that I did want to touch on when you originally asked me is that right now, I think a lot of people are exploring different financing types like DSCR programs. So we were seeing a lot of investors come to us for our DSCR program, which is a debt service coverage program. We want to see that the income of the property will be enough to cover the expenses of it. So on that program, it is a fixed rate for 5, 7, or 10 years, depending on the term that you go with. After that, the interest rate will adjust. So if someone thinks that rates are going to change in 3 years and they're going to be more favorable, then that's the type of program that I'm seeing them go in right now. Because right now too, I was just talking to someone today that mentioned they're seeing 30-year fixed rate options at like 7%, 8%. And some investors before all the rate increases didn't think about going with like an interest only product, which right now would probably be more favorable to them and increase their cash flow.
Sure. Well, it's a good point. And I think Josh, mentioned a good point too, because the shift is occurring where it is becoming more of a buyer's market. And I know that, my personal experience with a lot of the listings that we have, sellers, we're spending a lot of time educating the sellers that, yes, we recognize that the retail value of every single home in your portfolio today is X. But unfortunately, that's putting it at a 5% cap rate today. And, unless you're a very strong cash buyer that's comfortable with a 5 doesn't work anymore. It did 6 months ago. So So, a lot of them are starting to pause on their disposition as a seller. But as a buyer, there are a slew of new opportunities that are hitting the market right now. I mean, we're seeing builder inventory in pretty significant numbers that are offering discounts to retail. From whether you're a big buyer or a small buyer, I think there are real opportunities to take advantage. With home builders in your local market, if you can only buy 1 or 2 homes, you can probably go in and get a nice little discount to what was the retail price yesterday. And that goes for the portfolio acquisitions as well. So whenever there's some challenges, there's always opportunities, and I think there's we're going to see that for a little while, and for the sellers that can't get their price today, hopefully it's a 6-12 month window where things kind of level out again, and maybe it'll be an opportunity to sell in the future here as the rates come back down. There's clearly no shortage of demand in today's market, and would love, speaking on the demand side, would love to hear anybody's thoughts on that, because we all know that we have a shortage of supply of homes. Prices are at arguably all-time highs, but I think we all think that it's coming down. So where, given the opportunities and demand in the market, what are you all seeing?
Yeah, I mean,
I'm happy that. Go ahead, Josh.
I'll go first, and you can clean up my common mistakes I make. Yeah, I mean, I think to maybe quote an old adage, like I think a lot of buyers don't want to be caught, catching a falling dagger right now, right? Like I think we're in this awkward period where buyers have reset their buy box, right, and their expectations of what they need to get out of it, just based upon what we're seeing on the debt side. And sellers, it's been a pretty incredible whiplash, right? Like it's like 2 months ago, 3 months ago, they could have gotten a much better price than what they see now. And so I think it's just the human like primal behavior. Like it's like they can't really fathom what the new reality they're in. And so until you have that equilibrium between what buyers are willing to pay and what sellers are willing to move on, like we're going to be in a softer period, right? And I think it's if there's any possibility of home depreciation prices going down, like we're going to wait. Like we have a lot of dry capital or dry powder on the sidelines waiting for that balance, right? I think this is my personal opinion. Like the numbers we saw on inflation that came out for last month, they're promising that we've hit at least somewhat of a slowdown. And maybe it's not perfect, but I think the guidance that we've heard from a lot of our partners is late Q3 is when we think the opportunities will start to pick back up a bit more. But I think it really depends on if we can still see inflation numbers hedge as they have been in the next month. And so that's kind of how we're thinking about it, just based off conversations we've had with our partners.
Yeah, and I would agree with that from an acquisition standpoint. It's I grew up where when I purchased my first home, I think my 30-year fixed mortgage was at 8.5%, and I was really excited about it because it was a really good rate. And I think that there's a whole generation now that expects mortgage rates to be at 4% or less. So I think it's a little bit of just a refresh of the system, right? It's you look at rates today, they're not high, but historically, it's just it's a significant jump in the last 12 months. On the resident side or the tenant side, there's still a tremendous amount of demand for the product, and especially professionally managed, institutional quality inventory, that people are looking for, and days on market, from a leasable inventory standpoint, it's still really strong across the board, with maybe a couple pockets of with some saturation right now, but it's the demand is certainly there. If you are if you are an unencumbered buyer, they could just buy with cash and put debt on it at a later date, right? It's an exciting time, right? Because you can say what you're willing to do. You know, kind of going back to what Josh had said earlier about, you know, before people were doing inspections just so they knew what they had to deal with after they purchased the home. Now they can do the inspection and actually utilize it to, you know, to drive that price down potentially, you know, depending on what the results of it are.
Sure. I think Josh mentioned kind of an important phrase with, you know, catching a falling knife. You know, we're not in the same recession that we were back in 2008, right? And more recently, I think in the last couple of days, I've really been reading a lot of the builders saying, you know, or others, you know, commenting that we're more in a builder recession. So, you know, as far as an opportunity goes, you know, 6 months ago, very hard to buy a new construction home north of a 5 cap. It just, you know, everyone was, and it was spreading across the country. People were, you know, buying 4 caps, 4.5 caps, sometimes sub 4 caps. You know, now there is an opportunity for groups to, you know, to work with you know, brokerages like ours and you know, other builders to, you know, to achieve a discount that you can achieve a 6% return today. Maybe even a little bit more, you know, with getting a discount on you know, that home value price. So there's significant opportunity, you know, to buy good cash flow, you know. So in some regards, I don't see it as a falling knife, because I don't, and I think most agree that, you know, there's such a lack of supply that it's going to be hard for prices to drop precipitously as they did in the last recession. And hopefully they'll, you know, with a little more increase of supply on the market, which I think we're going to see, you know, ideally we get some price, you know, reductions and things start to stabilize as we move into next year, which would, you know, be obviously a big help. But there's real opportunity to take advantage of some of this now. So I think it's certainly becoming more of a buyer's market.
I did want to touch on something that Mike had mentioned about being able to purchase all cash. So what we're also seeing with a lot of investors is that they're doing cash out refinances on the equity that they have, right? It's year over year, I think we've seen increases in, like, I think double-digit numbers in most markets. So people are tapping into the equity, getting the cash so that they are able to purchase properties that come up as opportunities, all cash.
Seeing the same increase that Jacqueline mentioned, more cash out refis on the investor space as well.
And, you know, a lot of people don't talk about this, you know, because rents have, you know, continued to rise throughout this and seemingly are projected to continue to rise. But for the home buyers that were unable to buy a home, you know, they are saving, which sounds, you know, counterintuitive in a high rent market, but, you know, the average you know, rent per home is about $800 less than owning a mortgage today. So it is an opportunity for potential buyers in the future to rent homes, you know, provide landlords an opportunity to get a good rental rate. They're still saving more money than they would be if they were owning a home today, and hopefully ideally they can, you know, buy a home in the future with a better rate and you know, with some more supply on the market, you know, bring that price down and achieve, you know, kind of the American dream of owning a home. But, you know, as we all know, that, you know, that's changed dramatically too, and there's a huge glut of people that prefer to rent today, which is obviously all good for the owners and operators, everybody in the SFR and rental business. I will start with Peggy on this one. You know, what is your outlook for the rest of this year, but more so for, you know, 2023?
The rest of this year, most of our clients are saying is stronger towards the end of Q3 and then a solid Q4. So they're not looking for it to be less for the rest of the year. They're looking for it to be more and heat up in at the end of Q3. 2023, the build for rent market looks robust. Everything that's under contract now has CO dates that are in that first quarter, so that's something to look forward to.
Yeah, agree. Josh, I'll go with you next. Jackie, I'm going to end with you on this one just because everybody's going to want to know your crystal ball.
Yeah, I mean, I think I would agree. I mean, I think optimistically, as I mentioned before, I think the inflation numbers are heading in the right direction. That's kind of my bellwether, to be honest, of where things are moving. And so directionally, I think a lot of our partners kind of shared the same consent that Peggy mentioned as well, right? Like kind of mid-late Q3, things will start to heat up, and then Q4 will be, I don't know if we'll be back to normal, but like, you know, be higher than it is now. So more than less, I think is a good way to think about it. You know, I think 2023 is gonna be interesting because, like, you know, you mentioned the comment around, you know, being more affordable to rent than it is to own. I mean, I think the harsh reality is, because less people can own homes now, and it's becoming a very polarizing topic. Not saying it's right or wrong, but like, I think you'll see more regulation come into the mix in 2023 that I think people that are acquiring, people that are operating are gonna have to understand how to weave through that. And, you know, it's government bureaucracy. It's not gonna move fast, but it's coming, right? So I think it'll be a higher trend. I mean, we're seeing it now. Like we support a lot of property managers in Colorado that are now required to do inspections annually based off the city of Denver requirements, right? And there's cities in Florida that are doing the same thing. So I think that's a new trend that I think folks will have to factor that in terms of the overall P&L of the property. That will be more of a trend in 2023.
Yeah, I think that's a good point. You know, the renters that are renting, you know, new construction homes, assuming, you know, the economy and job market continues to do well, they're seeing wage increases. They have the ability to rent, you know, at high rates. What the affordable problem, that's where government, you know, obviously needs to step in and help municipalities, because it's you know, all those people that make less than 75 and 60 a year, they're not renting new construction homes, and they are also running out of options. And I don't we're not going to get into that topic because I don't know if anybody has a great answer on solving that, but it certainly needs to be solved due to the lack of supply of you know, housing in general and affordable housing. Certainly, Mike, what's your outlook for 2022 and moving forward into 2023?
You know, the first thing I'll say is I love Josh's comment about government regulation within the space. What's really going to be interesting to me is if there's any kind of a line that they draw in the sand as far as how many units you own, right? Because we've already seen a couple things pop up here and there in Minnesota, Wisconsin, here and there. It's like, if you own more than 25 homes in this, you know, this greater metropolitan area, this applies to you. But if you're the individual landlord, it doesn't necessarily apply to you. So I think that's something, I think you could do a webinar on that next year, right? That's going to be just totally across the board, all these different things we're seeing. So we're definitely staying tuned, you know, to what's going on there. Talking about what we're seeing, we agree, you know, with what everybody's saying. I think that I think we're going to see a lot of positive signs kind of rolling through the end of the year into Q1 of next year. I mean, the fact of it is it's super difficult to operate in an environment with price appreciation of 20% year over year, right? It's so hard to model out. I think about back in the day when, you know, when I was working more with our sales team, and if we put 20% assumptions in for market appreciation, we probably would have got slapped by somebody, right?
Yeah.
Because because you'd be like, you're crazy. You can't be telling people they'll make 20% on their appreciation of their home. And it'll be really interesting to see if, you know, if we, you know, if we slow down to where price appreciation is more in that normalized, say, 3 to 5% on an annual basis, is that going to feel like a loss to people, right? Is my home's value only going up by 4% going to seem like I lost money, right? Because I'm used to, over the past couple of years, of this just rapid increase in what valuations are. And I think it's all just going to be a reset of the system. At the end of the day, it's almost easier to operate with what we're dealing with now, just because there's less there's just less high flying numbers to really worry about. It's more about the set it and forget it and just kind of get back to basics and own assets and do a good job with them, and you're going to be all set. So we're very positive on that, the rest of this year and going into next year, and really look forward to what we're gonna see.
Yeah, I think it's an interesting point. I don't think when encouraging mortgage-backed securities in the late 60s and 70s and really pushing the idea of buying a home, I feel like it would have been akin to just how, if you talk to Warren Buffett, you buy a stock today and you plan on holding it for 30 years to make money. Nobody should anticipate, generating $200,000 on a house that they've put no capital in just because they bought it, 2.5 years ago. That's certainly not a realistic way to think about real estate. You always got to buy it right, but yeah, hoping for great appreciation is a dangerous game, and it would certainly be nice to see a little more stabilization in the market to come. Jackie, what are your thoughts moving forward?
I mean, I think we're still going to continue seeing a demand for financing on investment properties. I don't think that's going to slow down. I mean, with regard to rates, I honestly, I don't know where rates are going to be. But what I can say is that people who are both like bullish and bearish on the market, they're all still looking for the cash out refinance opportunities so that they have the liquidity, depending on where the market goes, to buy additional properties. Yeah,
I agree. And we play on a lot of different sides of the coin over here under roof, and we're definitely seeing challenges on the brokerage side and challenges educating sellers on where the market is, because everybody's just been so used to Mike, to your point, just it's been a 13-year rise. If you own something, it just has continued to go up and up and up. And it is starting to shift, and buyers are starting to get a little more leverage now from a pricing perspective, clearly not a loan perspective. So I see, for the rest of this year, it's probably going to get a little more challenging for sellers with significant portfolios to sell, unless they get realistic on what an appropriate or perceived discount to the retail value of every single home in their portfolio is for somebody to acquire a 100 home portfolio, because the debt markets are making it challenging, and they need a bit of a pricing discount so they can get the returns up. Because if Jacqueline is quoting a 6.5% interest rate, how can you buy a 5.5% cap rate portfolio? It just makes it very, very challenging. But again, like I've said, on the flip side, there's opportunities to buy with sellers that may have a need to sell and are not willing to take some haircuts on what the perceived retail value is, and certainly from builders. But it's also an opportunity for sellers of portfolio to offer seller financing. I've been trying to have a lot of those conversations with some of our sellers, because when you're at 6.5, 7, if it goes to 7.5, I hope it doesn't. But if you can offer seller financing at 5% and a buyer can put 30% down, it is it is an opportunity to create a disposition and some cash flow at the same time. I haven't seen a lot of that happening yet. We do have one portfolio out there where we've gotten assumable financing at 3.75%. So we're anticipating getting some good traction on that. But yeah, 2023, who knows? I'm hopeful that supply chains catch up. I'm hopeful that inventory catches up a little bit, ideally bringing some pricing down, and certainly hopeful that the debt leverages get back to what I guess is our recently perceived normal, but certainly we're at historic norms, I would say today. So should be interesting moving forward. Does anybody here have anything else that they would like to mention or suggest as a question to the panelists before we get into maybe some audience questions?
Actually, I had a question for Peggy. When dealing with the builders directly, if you're going to buy a package from them, is a lot of times the builder has an integrated title company, right? And whether it's D.R. Horton or Pulte or Lennar, you name the builder, right? Does it make sense for the individual who would be acquiring to partner up with their own title company, opposed to just kind of running the transaction completely through the builder? Is there some value to that?
It'll be a third party involvement. But normally what happens is the builder their captured title company will provide credits per the contract with the builder. So I think that's the negotiation point. There's always a benefit of having your own title company look at it and protect you. And also, having someone to even coordinate the transaction for you. So there are different levels of services that a national title company would be providing. Whether you're insuring it or not, we can still act as oversight companions for the transaction. And I think that's where, you have an operator that says, hey, these are my people, they're going to handle all 50 states for me. They may not be insuring and doing the closing, but they're going to take care of me. And, a greater value there is, 6 months, 8 months down the road, they want to do a securitization. If they deal with one partner that is going to oversee those transactions for them, guess who has all their prior title policies for their credits? We're going to make sure we have those. So depends on what your end game is. Makes sense. Yeah, that's a really good point.
Mike, here's a question for you, for anybody out there, that's not been in the space today, but considering getting in and kind of managing the nuances of moving into the space, whether they're a savvy investor from the commercial world or maybe just getting into the single family or build for rent space. But from your experience with both institutional investors and smaller mom and pops, what's the biggest mistake that you've seen owners make in looking and or managing the process of acquiring and or operating SFR portfolios?
Yeah, it's a great question, and honestly, it comes down to more so on the operational side. And what we see, the biggest variance that we see between an institutional portfolio and we internally we refer to them as retail investors, is at the renewal of an existing tenant. Our institutional renewal increases, hover somewhere between 9 to 9.8%. We have, for the last couple of years anyway. And the more individual owner tends to average somewhere between 2, 3, 4, probably more so on the low end of 2, because they're so scared of a vacancy. And I think what it really comes down to is that's a real risk, right? If you own if you own 1,000 doors and 10 of them go vacant because the tenant doesn't want to renew at that rate, you can absorb that, right? That's a cost of doing business. But if you own one home and you have a vacancy, well, Michael, that's 100% vacancy. Right?
Yeah.
I know I'm very good at math, and
That is
I think
impressive.
I think you just really need to be able to, whether you're self-managing it or if you're depending on any type of property manager partner on that side, really dive into to that question 90, 120 days prior to the tenant's lease expiring, because you can really start to drive up what the rents are, and you're not taking advantage of anybody. You're just forming to what the actual market rent is.
Yeah.
And I think that's a ton of value for for that individual investor.
I think those are all good points. Josh, maybe you can add a little bit to that question, specifically from the inspection point of view for new buyers. Has there been anything you've seen that you would advise somebody maybe not to ignore or really pay closer attention to if they're trying to decide, what do I rehab or fix, or what's really necessary or not, when they're looking at acquiring maybe a smaller portfolio of homes on their first go around?
Yeah, I mean, obviously I'm biased given the space I'm in, but what we see with the larger established institutionals is they're leveraging inspections on mostly every deal they're acquiring, right? Because it saves them money in the long run, right? So this initial cost up front, and depending on what your conversion is, from purchase and sale to close, like it could be a real cost of doing an inspection every property, but the reality is like the missed things that a GC is not going to catch, like foundational issues, major system issues, like that's what's going to kill, like between the vacancy comment that Mike mentioned, or you've got two homes and one of them you've got to put a whole new HVAC in because you missed something, like that makes a significant impact if you're a small mom and pop, right? And so we've seen a better adoption of this, but it's hard to like get a smaller investor over the hurdle to saying, hey, is it worth investing an extra $300-400 into an inspection as part of your closing costs to understand the true condition of the home, right? And it's kind of like the classic adage around preventive maintenance. Like people say that you don't understand the value of preventive maintenance until it's too late, right? And it's like very similar to the decision to inspect or not as well. And so I think the more we can make it easier to do inspections, especially in different geos, if you're a mom and pop trying to expand beyond your local market you live in, or make it easier to quantify the risk from that inspection, right, and provide it in a much more digestible medium. I think those are ways that we can get more mom and pops to move over. But I think it's a classic one. They look at the ones that are very established and they do it at scale. It's a good lesson learned for a new entrant coming in the market.
Yeah, I appreciate the insight. We've got about 6 more minutes here. So I want to take a couple audience questions, and this might be a good one, Peggy and Mike, given how much you see and deal with around the country. But what are the biggest barriers you are seeing from local government regulations? And I'm assuming some are bigger than others, but would love to hear your thoughts. Peggy, maybe we'll start with you.
Yeah,
Smile.
I shouldn't have, because there was more of a nervous giggle. No, I think the thing that you have to be very, very aware of is what are the jurisdictional rulings for compliance for code liens in any geography that you're going to work in. And what I mean by that is, I'll use South Florida as an example. You've got a code lien and it's unresolved. It will counterattach to other properties that you own. So, it could be something very slight, but it could be 2 years old and it may take you a while to clear it up. At that point, it locks everything up. So that definitely would be the number one thing. Understand from a jurisdictional standpoint how code liens work, you know, how many teams they have out on the street looking to see if grass cutting is necessary. It could be something that slight that could cost you days in a due diligence period.
Anybody
Yeah,
else?
and yeah, the only thing I'll say to that is, you know, when I got started in this industry, which was when I don't even remember, maybe 2012, something like that. You didn't, like, there was a lot of places you didn't even have to have rental registrations done, right? It was the wild west back in the, you know, back 10 years ago. And now you look at it, I mean, it's obviously a revenue generator, and it's going to be the second largest revenue generator to a municipality as compared to property taxes. And you know, it starts with, you know, making sure that you do have those rental registrations in place. It makes, you know, to the code enforcement, making sure when you are doing work, you're actually doing it appropriately. Making sure you have a good understanding across the board. If you're going to have a diversified portfolio, or if you're managing a diversified portfolio, nothing's the rule, right? It's like, yeah, when you have to issue a notice to a tenant, it might be 30 days in this market, it might be 90 days in this market, it might be 15 in this market, right? So you need to stay on top of all of those different things that kind of, you know, can be a costly mistake, right? As the manager, in the eyes of the courts and in the eyes of the municipality.
Yeah, and that's you know, a good point that almost brings us back to the beginning of you know, if you're not going to stay, which historically investors always stayed kind of in their backyard, but you know, with the advent of technology and you know, groups that are on the call here today that can manage portfolios, inspect portfolios, you know, run title across the country. You know, if you're going to move out of your local area that you as an investor probably know very well, it is important to assemble the right team through, you know, every step from, you know, going under contract to going through DD to closing, and then operationally, you really want to make sure that you're hiring the right groups that know the local, you know, ordinances well, and you know, assist you in being an efficient operator. We've got 2 minutes left. Here's a question for you, Jackie. What is the appetite for lenders to allow mortgage assumption, especially paired with another loan to cover the balance of the purchase?
So I mean, I can speak to what we allow. So our loans are not assumable. We would have to do a brand new loan. But we are allowing for seconds. So if you do find someone who wants to do a seller carry, or you have just another lender that can provide a second position loan, which I think might be a little risky to do right now, we do a combined loan to value max of 90%. So let's say we're at 80%, we'll allow a 10% second, but we do want to see that a client is coming in with at least 10%.
I appreciate that. And that leaves us with really about 30 seconds left. So I want to thank Peggy, Mike, Josh, Jackie for participating. Thank you for allowing me to moderate this. I will say to anybody in attendance, if you have any questions, feel free to reach out, and we can circulate a question and answer to everybody and follow up. Would love to hear from any of you all direct. And I really appreciate everybody taking the time, and a big thanks to all the panelists here for joining.
Thank you for having us.
Thank you.
Thanks, Michael. Thanks so much, everybody.
Thanks, everybody.
Thanks, everybody else.
Take care.
Take care.
Bye.
Bye, everyone.
Bye-bye.